you've got some 100% financing, meaning they don't have to bring a down payment. But are you saying there's also the potential they could come to the table, like not have to bring much of anything to the table in general, closing costs included?
I mean, we literally just closed a deal Friday where the consumer got back their earnest money.
Hi, Michelle Ternes here with Midwest Dream Team at eXp Realty, and I'm here with
one of the Daves from Halo Capital.
So we were having a little bit of conversation today and just thought, what are some of the questions that we're getting asked on both the real estate and the mortgage side that we could talk about and help people kind of break down some of these misconceptions that they have.
Yeah, and the two things that we kind of talked about briefly were one, first-time home buyers and the misconception that they need more than 20% down or need 20% down. We run into that a lot. And then two, what do you do if you want to sell your house and buy another house? How does that work?
Yeah.
So those seem to be conversations we have a lot right now.
Yeah, and I think honestly on the real estate side, we're having those exact same questions. So, so let's just dive in then. The 20% down, this is definitely a myth. I think it's been quite a while since you've needed 20% down to buy.
I trace it back to parents because parents, when they bought their first house in the 70s and 80s, or their grandparents did need that. And so that's just in their head from way back in the day.
Yeah.
And that hasn't been the case as long as I've been doing this for over 20 years.
Yep. So let's say you don't need 20% down. What would be the benefit of doing 20% down?
So in general, 20% down, first of all, is going to give you a lower payment, right? Just because you're borrowing less money, not because the rate's way cheaper or something of that nature, which is another misconception. Oh, if I put 20% down, my rate's lower. Not always.
Yep.
Sometimes actually it's cheaper if you put less down, which is very counterintuitive, and we can get into a whole conversation about that. But that's the big thing. And then you don't have private mortgage insurance or PMI when you put 20% down on a traditional conventional mortgage. The other misconception with that we have a lot is if you put like 10 or 15% down, that mortgage insurance can be like 10, 20, 30 bucks a month. It's really not that expensive. It can get expensive if your credit's low and you have a minimum down payment.
Okay.
If you have good credit and a decent down payment, it's pretty inexpensive.
So it's really a whole spectrum of things that you're looking at.
Mm-hmm.
Okay.
Yep.
So they don't need 20% down.
Do not.
And in fact, in some cases, it might be more advantageous to put less down and maybe pay off some other debt that you have, higher interest rate debt.
100%, yep. Oftentimes look at structuring a loan. So just because, let's say you have 5% or 10% down or 20% down, maybe it makes more sense to pay off that car or pay off a credit card. Because if you look at your monthly debt load on a depreciating asset, it actually makes more sense.
Yeah, absolutely. So what's the smallest down payment program that you have?
If you're a first-time home buyer, depending on the loan program, you can put 0 down. If you want to qualify for a VA loan, so you're a veteran, or a USDA loan, which is in a rural community, which we're not talking rural way outside of town, stuff as close as Bondurant or Huxley to the north, or Indianola to the south, or out in Van Meter, Adel, DeSoto, those qualify, places like that. On a conventional or FHA loan, you're talking 3 to 3.5% down as a minimum. But often you can get that as a grant or a down payment assistance. There's several ways to break that down. As we've talked before, we have 9 different investors that do different versions of that. And so we can talk through what makes sense for each individual person, but they, in a lot of cases, can get in the house with almost no money out of pocket, or maybe $1,000 or something like that.
Yep. And so when we're talking about, there's going to be really 2 components that they need to bring to the table, right? You've got closing costs and you've got down payment.
Correct.
And those are two separate
items.
Pieces. So 0% down, you've got some 100% financing, meaning they don't have to bring a down payment. But are you saying there's also the potential they could come to the table, like not have to bring much of anything to the table in general, closing costs included?
I mean, we literally just closed a deal Friday where the consumer got back their earnest money. So earnest money, if we don't know what that is, that's just a payment you put down when you write an offer that goes towards the transaction. So in this case, that they had seller paid closing costs. We used a down payment assistance program. They got into the house with nothing out of pocket, and since we closed in March, their first payment's not due until May 1st.
Okay.
Yeah.
That's awesome.
Yeah.
That's
So sometimes it's even cheaper. Like, I rent properties too. It's you pay first month's rent and deposit. Sometimes buying a house is cheaper because you have nothing into the deal and you don't have a payment for 45 days.
Right.
So it's like, oh well, think about that. It's a $3,000 or $4,000 budget swing for some people when you start thinking about moving.
Yeah, and we'll jockey around closing dates sometimes, even on the real estate side. If I have someone that is renting currently and they're going to buy, if they can skip a month where they don't have a rent or a mortgage payment, that's just more money to help them get in a better financial situation or be more comfortable, or build up more of a nest egg.
Buy a lawnmower.
Yeah, right. Moving is expensive.
All the things that you need, right?
Yeah.
But yeah, all those things. So really, people try to disqualify themselves from a mortgage sometimes, thinking they've got to save up all this money. And we have a lot of conversations around, if you buy today and live there for 6 months or a year, we could refi you versus you waiting 6 months to a year to save up a down payment and then trying to purchase. You're not financially further ahead in that scenario. And a lot of times people think they are. And sometimes they might be. And if that's the case, we'll talk about that too. We're not going to shove you into a house.
Yep.
But a lot of times you're not. And so we can walk you through what that looks like.
Yeah, and I'm going to throw a curveball at you because we didn't talk about this earlier. Let's talk about gift funds a little bit.
Yeah.
What can you receive in terms of gifts from like a family member
Yeah.
to apply towards your down payment?
So you can get gifts from a community, and like any grant programs that we have, you can get it from an employer. You can get it from a relative. You can also get it from an interested party, so like a fiance or a long-term girlfriend, boyfriend, whatever that looks like. We just need to document it and know about it. And there's ways to do that the right way that's easy, and there's ways to do it the wrong way that makes it hard. So talking to them, whoever we're working with about that and structuring it properly makes all the difference in the world.
Perfect. And we're gonna get to the selling a home, buying a home, kind of playing around with that. But I have a couple more questions for the first-time home buyer here. So let's talk debt to income ratios. What percentage of your income can you have walking into it debt?
Yeah.
What's that look like on kind of a general average perspective?
If we look at a really big picture, if you use a 50% number, you can go, some programs are less and some programs are more than that. But what I mean by 50%, let's say your gross income is $10,000 a month. We're just going to use round math here, okay? Gross income, because I don't want to do hard math. Gross income, not net, not what you put in your paycheck, not what you bring in your bank account, but like gross, 50% of that. So if you made gross $10,000 a month, you could have debts of $5,000. So at $5,000, you could subtract out student loan payments, car payment, and that'd tell you what a max mortgage payment is. You don't have to include things like cell phone, insurance, MediaCom, or whatever you have for ancillary things, just what reports to credit.
Okay.
Some programs go higher than 50, some have less, so it just depends on what we're doing, but if you just ballpark, that's a good starting spot.
Okay. And just to have a little fun with this, what's the funniest thing you've seen on a Venmo comment? Because, you know, you got to see all of those things.
I can't say, because I got some renters that pay us in Venmo, and the comments I get are pretty ridiculous.
Yeah, we had a situation once. We had a buyer that their friend thought it was funny to send them money and write child support.
Oh, yeah, you don't.
And it became a whole thing. They ended up just like having to jump through a ton of hoops.
Yeah, that's a tough one.
Yeah.
Cash is a dirty 4-letter word in our business.
Yeah.
Child support's usually a red,
a
red flag.
Even when it's not child support.
Even when it's not, and people think they're being funny.
Yeah.
Yeah.
Yeah, so a lot of funny things that we see behind the scenes.
Yes.
Okay, so let's shift gears from first-time home buyers to now we're talking about you've got a home already.
Yes.
You need to sell that home to buy a home, or you're not sure if you need to sell that home before you buy a home. What are some options to get you through from home A to home B? Yeah,
so a lot of people are concerned about that, and they don't want to have to move twice. And I get it. Moving in one day is awful. Packing up all your stuff in a moving truck, and I've done it. It's awful.
Yeah.
So to buy a house without selling a house, you have to qualify for the payments. That's step one. So do you qualify with your current mortgage payment and with your future mortgage payment at the same time? That's question one. If you do, then how do we take the equity out of your house and use it as a down payment on the next house becomes the question. And there's a couple of ways to do that. So one, we can look at doing a minimum down payment on the new house. So we can put the minimum down payment if you own another property is 5% on a conventional loan, or 3.5% on a FHA loan. And you can't do USDA if you own another house, and VA will vary, so we won't get into that complicated thing, but you can do it. Put the minimum down, and then once your house sells, you can actually do something called a recast.
Okay.
So during a loan cycle, the investor allows you one time to pay an additional 10% towards the principal. So if your house is $100,000, pay off $10,000. one time they will redo your payments as if you put that money down up front over the remaining term. So if it takes you 6 months to sell your house, they're going to pay it down. They're going to go over, instead of 30 years, over 29 and a half years.
Yep.
What your balance is today over 29 and a half years, and redo your payment.
Okay, so let's say they have $100,000 in proceeds. They really have a couple options with that. They can just put it in there and pay down the principal, or they can do a recast, which then it makes their payment go down.
Yeah, so they would take, so let's say you buy a house, we'll use getting round math, at $500,000.
Yep.
You just put the minimum down, and then you sell your house and you make $100,000. You then take that $100,000, put it towards the $500,000. They'll redo it as if you had $400,000 loan balance day one over the remaining term.
Okay.
And either they do it for free, or they might charge a small processing fee of a few $100. But you don't have to refi. It doesn't reset your interest rate. It just redoes the minimum payment.
Right. It just changes that amortization.
Correct.
Okay.
Yeah.
And let's say maybe someone doesn't want to go that recast option. What might be some other options?
So if they've got some equity, they could just not even recast and take that $100,000 and put it on Red 7 and go to Vegas or
Prairie Meadows, baby.
do this thing. Or they can invest it or do whatever they want, and then they're set up that way. They could do a bridge loan. Okay. So a lot of people hear that term, but they don't necessarily maybe know what it is. What a bridge loan does is it pulls the equity from your house and allows you to bridge the gap between when your house sells and when you buy. So those aren't free because they're a loan. Yep. So you have to be able to pay your house payment, your bridge loan payment, and your new mortgage payment. That would be that option and how that works. Typically, bridge loans will go up to about 80 to 90% of the home's value.
Okay.
Because of course, if you're going to sell it, you're going to have things like real estate commission, closing costs for the buyer, and just general fees, even if you were to sell it to your uncle for free. Like, you still have costs. So they don't go up to 100% of the home's value. And then you'd use that money as your down payment at closing. Then that would be an option as well.
Perfect. And let's, just because you're investment minded, let's talk about a third scenario.
Okay.
I mean, they could take that property and not sell it at all and turn it into a rental property. What would that look like from a qualifying perspective?
So if you were to take your exit property and you were just to rent it, we can wash whatever payment you have on that property away. We can't count any income for it right now, unless you have a history of being a landlord. Then I can count income. If you don't have any history of ever renting a property, you can lease it, get a copy of your first month's rent, and we can wash that payment, and now you're just qualifying for your new house like normal, as if that house was sold. If you don't need to do that and are just gonna rent it later, you just rent it. Your mortgage says that you intend to occupy a house as a primary residence, but if you have, you're allowed to not be your primary residence anymore and rent it to someone. That doesn't violate your mortgage. What violates your mortgage is buying a rental house and calling it a primary residence and never actually using it as your primary residence. But if you have, there's nothing that says if you have a great rate, 2-3%, which some people have right now, right? You could keep that mortgage, rent it, make that money, and go buy something else.
Right. What a great opportunity to get into the world of investing. I made the mistake of, we wanted to take our proceeds when we built our house, and so we used that towards the down payment on our next house, and just kicking myself, because then we got into the investing world after that and bought 3 rental properties for more money than what we owed on the other house, and we would have made so much more money in rent.
Had you just left it?
Yeah.
No, it's an interesting opportunity. I'm glad you brought that up in the coming years, because in some investment groups I work with, there's a lot of people, they use a term called, we're getting way in the weeds here, sorry, called sub 2.
Yes.
And all sub 2 is they're using your loan, whatever it is, to then resell it to a third party and make the delta in between.
Yeah.
But there's no reason you as a seller couldn't do the same thing. I've got a payment on a house at $1,500 at a 2% rate. Well, rent's $1,800 or $2,000. Rent it.
Yeah.
6 months, a year, 2 years, you hate it, doesn't work out, then sell it.
Right.
You know, you can always sell it down the road if you don't like it.
Yep. So,
or call Michelle or me and we'll do a sub 2. Just kidding. Just kidding.
So in that case, as long as they have a lease agreement in place and they've got the first month rent locked down, that's going to get them to basically wipe their hands clean from a debt perspective of having to look at that debt that they owe on the existing home, and they can move on, qualify for that next home as if
that doesn't even exist.
Doesn't even exist. Okay. Very nice option.
Yeah. So there's lots of ways to do it. Again, just like with the first-time home buyers, a lot of times people haven't really talked through their options, or maybe they'll Google it and then they won't really I mean, that's fine, or AI is fine, but it doesn't really know all the nuances of what we do. We're not fully robot replaceable yet. Maybe at some point, but not yet. And so just talk to an expert and figure out kind of what those look like. But there are options to hold on to your current mortgage or your current house and sell it after you close on the new one.
Yeah. So let's just talk a little bit while I've got you about Halo and what makes Halo different than some of the other mortgage lenders out there.
Yeah. So I guess I don't know if this is going to cut in or cut out, but I've been doing this a little over 20 years, and I've worked in a couple of retail or mortgage companies. And one of the things that makes us different is that we're a broker. So we don't lend our own money. We are lending other people's money, which makes people sometimes a little, oh no. But we're working with large mortgage companies, so really large ones like United Wholesale Mortgage, who happens to be the largest mortgage company in the United States. So that's not really necessarily an issue. But what is great about what we do is we're not tied to just that one company's deal. We have like almost 30 investors that we work with. So depending on the client's situation, it might make sense to go to that company, or it might make sense to go to this company. Well, you as the agent or the consumer, you don't have to know mortgage programs. It's my job. I just pivot for you and get you the best deal in the market.
Yep.
And so that's why we have 9 different first-time home buyer programs. That's why I can go out on Tuesday if this investor has a sale on a rate, essentially a sale, we'll call it that, I can take your loan there. But if that sale goes to this investor the next week, we can pivot.
Yep, so you're not fixed, you're not stuck, and you have a program for almost anybody.
Almost anybody. We can do it. And we get turn downs and deals from other mortgage people, like all the time. A lot. So we are a really good one-stop shop, and we've been doing this. The other Dave has been doing it for 25 years, and the other Dave's been doing it for like 15, and I'm at 20. So got a lot of knowledge of how to solve problems and figure things out.
Yeah, we always say if the Daves turn you down for a loan, you weren't going to get a loan anywhere else.
Unfortunately, or if we don't know where to take it to help you figure it out, then we'll probably take it to like credit repair or to an accountant. Figure out what's going on to get it fixed.
Right.
Yeah.
Well, awesome. Yeah. Well, appreciate you sitting down with me and
Thanks
chatting
for
through this.
inviting me to do it.
Yeah. All right.
Cool.